Go ahead. Hello, everybody. This is Angela Tsukiji. I'm the VP of Member Services at the North State BIA, and I'd like to introduce to you our President and CEO, Michael Stretch.
Good morning, everyone, and welcome to the North State BIA Breakfast Blend. While our online format is a bit different than having a full breakfast at the Hilton Hotel on Arden Way, our content this morning promises to be strong and of great interest to our industry, particularly where we are right now in the market. And this session really couldn't come at a better time, as we just experienced our best February since 2005, as well as 9 strong months in comparison to year over year from 2020 to 2019 to 2020, 9 straight months of increased sales. We probably wouldn't have thought back in March of last year that we would end up with such record home sales for 2020. It's been a good run. We feel like we've got a long way to go to address the needs and the demands of home buyers and renters throughout the Sacramento region. We've heard it many times before over the last 90 days and lots of credible media publications. Sacramento is one of the hottest markets in the country. So let's learn a little bit more about what's going to be happening in the future, some opportunities, some potential challenges. And I'd like to kick it off this morning with an introduction of our 2021 North State BIA Chairman of the Board, Mike LaFortune. Mike?
Well, thank you. Well, good morning, everyone. So great to be with you today, and thank you for joining us. When we held our first virtual breakfast blend last year, we all hoped by now we'd be meeting in person and things would be very different. The good news is we're all optimistic that we will be able to meet in person in the near future. Now that we have 3 vaccines, distributions of these vaccines have increased, and the number of cases has been steadily declining. I'm very proud of how our organization and our members were able to adapt and strive over the past 12 months. As Mike alluded to, our builders had a very successful 2020 with over 7,000 home sales. And we expect 2021 to be another strong year with home sales predicted to be over 8,000. This is a true testament to the quality of our builders, developers, and associates. Even with our recent success, there are warning signs ahead, as Mike mentioned. The housing shortage continues to grow. Recent studies show that we're only building about 2/3 of the homes that we need. And over the last 9 years, we're only building about 25% of what we need. We need to stay diligent and focus on helping to push back on higher costs, lengthy approval periods, and processing delays. Now is the time really to, we're asking all of our members become more engaged, more involved. We need each of you to help us grow our memberships. Events like this are very important for our members, and we're very thankful for everyone that's involved in it. Our voice and our message is more powerful the larger our organization becomes. We are stronger together. So I look forward to working with everyone this year. It is an honor to serve as your chair, and I'm excited to start today's program. So to go through a little bit of the housekeeping items. So as you will, all of you will get an email from Angela that will have 2 links in it. One is a survey, which will give you the opportunity to give us your feedback on today, and also provide suggestions for topics for future events. The second link will be the project and profiles resource book that the good people at Next Group of companies have volunteered their time and energy to put the book together for us in electronic format so you can still have access to the content of the builder information and also view profiles of various trade and associate members. Thank you to the members that contribute to the content of this book. This is an important resource to help connect members with members. Lastly, before we get started, I want to make sure to mention our event sponsors for today. We are proud to mention the following members that are helping to support the BIA by sponsoring today's event. Blue Mountain Construction Services, DAHLIN Group Architecture Planning, Guild Mortgage Company, the Monty Maxwell team, Integrated Resource Group, Wood Rodgers, and Zurier Company. In addition, sincere appreciation to the companies that are in our chairman's circle. Their early commitment to support the North State BIA events throughout the year provides the BIA with a strong financial foundation that allows the association to focus on providing advocacy, representation, information, and education that we all need to be a strong industry. Please review these amazing sponsors in your resource book. We also want to encourage everyone to become a Chairman Circle 2022 next year. Now on with our programming. Even though this is a virtual event and not in person, we do want to provide you with as much of an interactive experience as possible. So if you have a question, please be sure to use the Q&A function at the bottom of the screen. We'll do the best we can to answer all the questions, but we also are striving to finish on time at 9 a.m. this morning. Today, we're going to receive some insight and knowledge on a very hot topic, build for rent. You will hear from 3 industry leaders as they share their insight on the growing phenomenon and how it is creating opportunity for our industry. Our featured speaker is Dean Wehrli with John Burns Real Estate Consulting. Dean manages residential and commercial real estate consulting assignments across the country and has a deep knowledge of California's Bay Area, Sacramento, and Central Valley markets, as well as Northern Nevada. He specializes in aggregating housing market trends and conducting primary research, including consumer research to recommend the product segmentation that will maximize price and absorption for specific target buyer profiles. Dean is the host of the New Home Insight podcast, the premier podcast for insight on the U.S. housing market. If you have not listened, I highly recommend it. I enjoy the podcast. Dean, well done. Before joining John Burns Real Estate Consulting in 2010, he's managed market research consulting assignments for the last 11 years. Dean has a PhD from the University of California, Los Angeles, and a BA in political science with Cal State Fullerton. With that, Dean, the floor is yours.
It's essentially, when we're talking about BFRs, we really mean, think of the analog to apartments. You're going to hear me say that a couple of times, but that's really true. It's, communities, defined communities that are just with no one above or below you. The product can be really varied, though. There's lots more attached product than folks realize in the BFR world. It's not just truly conventional lot, single family. That's the historical norm, but it's much more than that. It's townhomes and duplexes. You even see apartment-like parking situations. All kinds of different hybrid models are starting to happen. But effectively, it's that single community managed by a single entity, very much like an apartment complex. That's what when we mean build for rent, that's typically what we mean. I know there are people doing onesies, twosies all the time for that nowadays, but that's mostly what we're talking about. It's happening everywhere. This map is from the fourth quarter. A lot of this data are going to be a little bit dated. They're from last year or from late last year. This one is from the third or fourth quarter of last year. It showed our database. It's much bigger than this now here in March of 2021 than it even was a few months ago. These are the actually dedicated BFR communities that we're tracking across the country. You can see they kind of, and it's color coded by the type of product that going on. You can see a concentration though, kind of the smile states a little bit, but not a whole lot on the corners of the smile. It's not a frown, but it's more of a flat. But you also see quite a bit of activity in the upper Midwest. People don't realize there's a lot of, and historically has been a lot of BFR activity in places like Indiana, Illinois, Michigan, and Ohio. So it's a much more varied, and it's just, but the main point here is just a really, really expanding sector. The huge part of the expansion has been COVID. So COVID-19, of course, we know in the for sale world, it pushed all kinds of out-migration out from, in our part of the world, from the Bay Area, especially core parts of the Bay Area, like the city of San Francisco or Silicon Valley. It pushed them out into more outlying markets because suddenly they could work from home, and they could work and they could buy a home for much, much, much less money, bigger home, lower density. But what that means is that it made these people really think about home, but not just the size of their home, the rooms they had, but what they did there. And of course, one of the most important things they did there was working from home. You see this little family here. everybody's sort of sheltered in place and they're doing their own thing. But what that means is that they needed more space. So, and they needed maybe a different area, maybe more suburban environment. So you see a lot of folks go from the apartment world to the BFR world, to the single family rental world, because the product is the same. Their needs for product were the same, but they're more able to find, but they needed bigger homes, outlying suburban markets, and BFR made a lot of sense to those folks. Go ahead, Angela. And I want one more slide on home officing, because we think that's a huge, huge impact that's going to last well beyond COVID-19. There's a lot of debate. Home officing was kind of percolating up and gradually becoming more common prior to COVID-19. Of course, COVID-19 just exponential growth in working from home. We think there's going to be a major part of that residual post-vaccine that'll still be working from home. Some of that is aspirational. Folks are going to want to work from home. There's going to be a give and take between employer and employee in terms of whether they're able to work from home. But we think there's going to be a massively, probably more like something like double of people post-vaccine, post-pandemic, working from home at least part of their time, if not most of the time, than there was before the pandemic. So that's a huge, and build for rent is just much better able to accommodate that than apartments are, with space, with room count, things like that. Go ahead, please. And so consequently, we've seen we'll start getting into kind of the growth in the market though. So rents have risen now about 4% in 2020. This is when home prices, of course, were rising at a much faster rate, but we're now tracking over 300 dedicated BFR projects in our database, and we're doing a lot of work. And I'll talk a minute about the where we're doing those feasibility studies for BFR is changing very gradually here. It's coming into the higher price markets, and it's coming into Northern California fairly semi-recently. And so, but we're seeing more activity. We'll see that last bullet there at the bottom. You're seeing more land activity that is meant for dedicated BFR communities, where that was a blip, that was effectively non-existent even a few years ago. So it's really kind of reshaping the housing market as a whole. Go ahead, Angela, please. But here's the key, I want to stress this. BFR is still completely dominated by, well, I shouldn't say that, I'm sorry, single family rental, SFR, is completely dominated by moms and pops. Just the people who own, at the top bar you see there, 77% of the single family rental stock in this country is owned by a true mom and pop, one or two. Another 11% are 3 to 5. I would say up to 10 is really a mom and pop. And in terms of truly institutional actors, that's about 2% of the market. So think about that. We went after Tricon and after BlackRock, and everybody went on their buying spree, their portfolio building spree a few years ago. They still only have a little over 2% of the market. Smaller institutional folks have about 5% of the market. That means there's just a massive runway, a huge, huge potential for growth from more institutional actors. And so that's mainly where we see the activity and the interest. Those institutional actors are pretty cautious about what market they go into, and they're careful and they do their due diligence about what market they enter. But once they enter a market, they're pretty omnivorous and they're pretty hungry for product and for just to add to their portfolio. So that's critical. There is room for tremendous growth in the institutional part of this. Please go ahead, Angela. So here's some of the big boys, Invitation Homes, American Homes for Rent, and Amherst, Tricon's a big one. These guys are dominating the space right now, but there's lots of other actors. We had another slide, I'm not showing it, but we had another slide of folks who had less than 5,000 homes. There's a whole bunch of groups like NextGen who are doing a lot of work and are also hungry. There's gonna be some aggregation here eventually, but a major important point is that a lot of investors, a lot of people on Wall Street thought these guys were going to build up their book of business there, buy them cheap when the market was down, rent them out for a little while, and then sell them off. And they're not doing that. They're acting as effectively like an apartment developer, a REIT or something like that. They're keeping, they are mostly in the acquisition mode, not in the sell-off mode. And for the most part, that's how they're going to remain. So this is a lasting. This BFR is not a temporary thing. It's for sure going to be here forever. And almost certainly it's going to be in growth mode for the indefinite future. Go ahead, Angela. I mentioned a minute ago that where the activity is, and it's in the southeast and the southwest is where most of the land activity is. That is where most folks are buying land with the intention to develop as BFRs. There's not a lot. This is a survey, so some zeros there for Northern California toward the bottom here. That's a survey, so that's a bit of a blip. But it does indicate there's been very little activity so far in Northern California, Southern California, places Northeast too. That's starting to change. Like I said, we're doing a lot of work here in Northern California, in Central Valley and Reno area. And I'll talk in a minute how that work is changing geographically. But let's be clear, that places like Phoenix and Texas and Florida are where most of the BFR activity still is, and probably will be the majority, just because it's all about the price of land, to be honest with you. Here, so here's talking about some rental rates and how in 2020, BFR single family rental rates went up only about 3.7%. Solid, but it was positive. One of the things we've noticed that we have data going back, I think at least to the 1980s, I don't have it here, that shows that single family rental percent growth or percent change, I should say, in rents has been positive every single year since going back to the 1980s, but not dramatically. It doesn't have the huge fluctuations that the for sale market does. It's a much more stable kind of market environment, but it really is resilient because I'm not kidding. I think it got down to something like 0.3% in its worst time. It weathered the storm of initial COVID-19 much better than the apartment sector did, especially much better than the urban core area apartment sector did. We know in the Bay Area, they had some huge rental losses. They're stabilizing now, but they've had some big rental losses in a way that BFRs really didn't and SFR really did not. And you can see down, so we have 63 markets we're covering here for SFR, 20 we call core. That's really based on them having a lot of activity. That's probably the wrong word, to be honest. For the other 43 we call non-core, again, the wrong word. But you see Sacramento there was one of the best performing single family rental appreciation rate markets in the country last year. It felt 7% market appreciation for the year. One of the Tucson was better, and that's about it. Riverside, San Bernardino, the 909 shout out, and Phoenix, of course, which is a boiling hot market for about everything, but especially BFR. Now this map shows where everybody is in terms of the appreciation last year. And it's hard to see, but look over there, that green dot, that darker green dot that's in between Vallejo and the word Sacramento, that's Sacramento. And that's one of the relatively few green dots, which means they had a growth rate of 6% or better. You can see the little red dots over there to the left of Sacramento. That's the core Bay Area where they had some modest depreciation just in those markets. And Stockton, by the way, is that lighter green dot, good solid appreciation too. So you see the inland markets within California tend to be a little more healthy in terms of the BFR world than those coastal markets. So that's good for us. Go ahead. Now, the point of this slide, I'll move on pretty quickly here, but the point of this slide is that the BFR renter is almost indistinguishable from the homeowner in your same area. So if you have a master plan and you're thinking about doing 8 neighborhoods, and maybe one of them you might want to go BFR and the rest are going to be for sale, and you're worried about that, you're worried about how the impact and the folks you're going to get renting there, they are demographically going to be almost the same. Their income is going to be very similar, their education, their marital status, their household status, their life stage. They're going to look very, very much the same flavor as your homeowners there. A couple of things that are different though is that BFR people tend not to be demanding in terms of spec level. They tend to be a little more accepting of relatively smaller lots, and they tend not to pay for going bigger and adding space to the same degree that you tend to see a flatter slope on the pricing slope for BFR. So they're a little different in those ways, but demographically, they're very much the same. Okay. So financing, here's, think apartments. I mean, we have a lot of folks. I've had major developer clients think, we don't know what to do with BFR. We don't know how to treat it. We don't know how we're going to get our money back. We don't know how to do an IRR. They really have to be thought of as very much like apartment complexes, because that's really what they are and how they're going to act and how they should be financed or not financed. Go ahead, Angela. Here's one thing that comes up a lot with the money people, though, is that they're looking for experienced operators, which is a little bit of catch-22 because it's such a new space and there are a lot of not experienced operators. But I had a podcast with a major bank person who's very big in the BFR space, and I asked her, when you're looking at BFR, is it location, is it market? Don't get me wrong, she wants to see the numbers work, But the biggest thing here is that operator, how much you trust that operator to do a good job and to execute. So that's critical. And then in terms of high land cost, that the core areas with the higher land cost, that does make folks nervous. I put Beverly Hills there. I don't know why. That's what came up in Google Images. I'm sorry. So go ahead and the next one, Angela, because what that means is that we're seeing the start to move, the interest in BFRs start to move from those fringy areas into more core areas, but maybe not that much in true core areas. But what I mean is like, so a few years ago, it was in Merced and Modesto and Carson City. Now we're doing work in Rancho and Cordova and Lincoln and Roseville and Elk Grove and West Sacramento. But we're not in the Bay Area, Hollister, Santa Rosa, American Canyon, but not so much in those true core high land markets. And because that does make financing a little nervous. And go ahead, Angela, the next bullet. Well, what that means is that we're going to see this battle over what product is. So in other words, the money part of it really pushes you towards a high yield and getting more units, and that to make the deal work. The historical appeal of BFR, though, is in large part because it's more like conventional single family homes. So we're going to see, I think, go ahead to the next one, but I think the answer is going to be diversity, depending on where you are, depending on who your renter targets are. You're going to see everything from that horizontal apartment that lives very much like an apartment complex. There's just no one above or below you, all the way to the true conventional single family 5,000 or 6,000 square foot lot product, and lots of stuff in between. We're gonna have hybrid parking situations to try to solve for this.
Thanks, Dean. That was awesome. Lots of stuff to unpack there. My name's Christopher Brown with the next group of companies. I'm going to be your moderator for today. I'm joined today by Mike Paris of BlackPine Communities and Kevin Yttrup of Premier Homes, and Dean Wehrli, who we've just heard from. And so we're going to unpack a whole bunch of stuff today. I think there's a lot of interesting things to talk about. Let me start out with Dean, you had talked about this buyer profile or renter profile is almost the same between the two. So if they're the same, have you guys done any deeper dives into why they're renting versus buying?
Yeah, that's a lot of it is mobility. So they don't want to be tied down, quote unquote, to a for sale house. They don't know where their next job is going to be. They don't know where the next job they want to be. Some of it's that. Some of it's credit. Some of it's they might have a credit issue. Some of it is down payment. They might not have the down payment. They don't have a lot of savings, but they have good incomes. It's probably, and some of it's just they prefer to rent. Maybe they've done that rent versus own analysis, and they actually prefer to rent. And the mobility, by the way, could be both geographic, like the market, they want to stay here or there, but also could be neighborhood too. And sometimes they're dipping their toe into a neighborhood. Do we like this? Do we like the schools? Do we like the neighbors? And they'll buy in that neighborhood after they've rented for a year or two. So it's all those. So it's not. That's why it's not the sort of the mark on this was that, oh, it's something about their credit or their income, something like that. That's a very small part of it. Of why they're renting.
Interesting. Real quick for the audience today, in the bottom of your screen, either click on the chat or the Q&A if you've got questions as we start talking today, and we'll try to get to as many of those as we can as we get through this. So a question for Mike or Kevin is, given that this is the same buyer profile, what are you guys seeing different in the product, or what is the product like in a BFR versus an SFR?
I would tell you, Christopher, it's product wise. I think it's something that certainly the finish and what goes into the home is definitely a different level. I think there's the need to build or design product that can be repeated. There's some economies in volume purchasing of the different materials, and there's also a volume play with the timeliness of the build. Remember, we're not trying to move product and hit certain absorption rates and sales. We're just trying to get through a build really fast. So the product is different by design for how it needs to be built, and and ultimately trying to get the price point to where it's going to get a pencil.
Yeah, that's good. Mike?
Yeah, I can add to that. You know, my experience is kind of a long runway getting into this asset class, and we kind of fell into it just by virtue of kind of what's happened in the last year. But certainly have seen, you know, the bill for rent historical background in some respects came out of the ashes of the recession. There were a lot of asset consolidations, things challenged about how to manage individual houses. And I think what's happened in the last year with the pandemic economy we're in, it certainly accelerated people's perspective on their homes, where they live, their lifestyles, to the points that Dean brought up. One of the things that I could probably add to what Kevin said with regards to product, I agree. There's a tipping point with respect to the size of the home to where it starts to work against you. You don't get an added value in rents because the house is a few hundred square feet bigger. The other side of it is diversity in product types. And we're struggling, I won't say, maybe struggling is not the right word. We're challenged with some of the peripheral parts of the core markets, with the municipalities adopting to the hybrid of an apartment versus a single family, with respect to setbacks, with respect to fire code provisions. And so we're having to kind of walk through that very carefully with them and educate them on the asset class as well. So I think the product itself will evolve, but it's certainly in the early stages of understanding how not only to fit our buyer demographic or our renter demographic into it, but also how the municipalities react to the site plans and the things related to more of a single family density component in an apartment complex.
So Mike, question for you. You've got, you know, you talk about kind of the differences in the municipalities trying to figure this out. As you're submitting for a project that is maybe originally planned for an SFR, but is getting changed into a BFR, are you seeing the municipalities changing the rules for that product type based on the fact that it is going to be a rental?
Not necessarily. I'm seeing various interpretations of how that crossover or how that hybrid gets viewed within certain jurisdictions. And it hasn't been consistent because it's such a new component in many site plans, especially when you're trying to remap or convert maybe a single family for sale community to a for rent community.
All right, that's good. You know, I think, you know, one of the things that we had talked about, you know, as we were prepping for this is the opportunity from a product standpoint. And, you know, California, as we all know, we've got a big push on us for affordable housing, and we're trying to figure out how to accomplish that. And given our land costs and given our fee structure, it's really difficult to provide affordable housing in California, and especially Sacramento. You know, as we look at that, I think BFR is certainly a phenomenal opportunity to try and achieve that, and maybe get into something that's higher density, but maybe higher amenitized, meaning you've got a central core, kind of like you would do with an apartment complex, but in an SFR kind of product type. You know, what do you guys think of that?
Yeah, I would say, you know, it is something like everyone on here today. We're all new to this, and we're all kind of figuring it out on the fly here. And we've looked at several different structures. You know, you get from everything from just what could look exactly like a single family for sale neighborhood to more of a repetitive product. And it's hard to, you can see, like as Dean shared, there's a lot more that's going on in the upper Midwest and even back east than California at this point. It's our fee structure, it's the cost of land, makes it very hard to pencil here in the West Coast. And that's why we're looking at all different structures of how to put the project together and find some economies in it. I think, you know, it is it's one of those things where, though, right now, timing wise, there's so many things feeding into it that the demographic, I think, as we watch the numbers of the people looking for this type of product, it's going to be one of the hottest growing demographics for sure. And as builders, I think it gives us some diversity because it's also somewhat market insulated. So, if market's slow on a single family for sale, it might be that, one of the next things we're up against in this region is affordability. We have strong demand. I think that'll continue for a long time. It will be just purely, can the person buy and afford to buy a home, or do they need to look at something like single family for rent or built for rent? So I think it's something that's certainly we need to. Everyone's looking to figure it out on the West Coast here with our cost structure.
Yeah, I think our cost structure is our biggest hindrance, for California and trying to figure this thing out. I think with our fee structure, our land costs, and then obviously all the directs that we're experiencing right now, it's tough to get something to pencil here. And you see why it's so popular in other markets. I know we've got a local builder here that is very well entrenched here, but is not doing this here, but it is doing in other markets because it made more sense in other markets and didn't really make sense here. And I think there is multiple projects that we're all working on that are coming into the pipeline and that are already underway that it's here, but it is an unusual model that we're all trying to figure out as we go. A couple of questions that have kind of popped up in the chat. Mike, we had talked about, you referenced this a little bit earlier, but are you seeing really any municipalities distinguishing between SFR and BFR? And then are you seeing any pushback on getting approvals if it is a community that is a BFR?
No, I'm not seeing any pushback. I think probably where we've run up with a few challenges is really communities or the municipalities concerned with it becoming a lesser quality, or the perception that a leased home is going to be lesser than a home for sale. I think the structural challenges we ran into were really more about trying to generate some density levels and to apply it to a single family versus a multifamily component. There's a lot of challenges with regards to just the infancy of this asset class across the board. And it runs not only with municipalities, but it extends into insurance, it extends into the DRE, it extends into if you're looking at it in a master plan with CC&Rs that are in place. So it's a little bit of all of the above.
Yeah, absolutely. Kevin?
Yeah, I think for me, it's one of those things too, along with what it might go across with the different jurisdictions for approvals. We're having the battle internally. In a master plan, for example, we have to ask the question, does it potentially erode the values of our single family for sale product if we're building in close proximity? How do we keep that from happening? We've had to look at, even if we've got a plan that doesn't even have to have HOA, or we might want that for the village of the single family for rent for sure. We're going there because that needs to be a stricter set of CC&Rs. There needs to be a way to enforce it. You can't just rely on the state and the city or jurisdiction to enforce it, and so that's the challenge. So it's beyond just the approvals at the county or city level. It's also something we're working through within.
Yeah, no, that's a good point. Dean, what are you seeing in some of the other markets, as the adoption of this from the cities and counties that your other clients are building in?
It's like Mike said, there is, in a lot of places, there is just confusion. They're not sure how to treat it. I mean, should they have different setbacks? Should they have different density designations to accommodate BFR? Because they are going to be typically a little more dense than the like for sale community. But for the most part, though, they have. I mean, there's no innate antagonism from the city on it whatsoever. They just don't always know. They need to put it into a bucket that they're used to, and they don't always know what bucket to put it in. I think that's where the confusion, or that's where there's slowdowns or something like that.
Yeah, we're all kind of making it up as we go. I think that's the interesting part. Mike brought up a good point. As we look at these, and Kevin, I think, is addressing it also, is that the regulations need to be a little tighter when we look at these, especially as they're integrated into a master plan that is traditionally SFR. It is making sure that we've got those HOAs in place, and then the preservation of value. But I also think it's going to be a cool opportunity for the affordable housing side to be able to do that. You know, as we talk about a lot of pressure on all of us to do inclusionary housing, this is probably an easier way just from an adoption standpoint. Inclusionary housing is really difficult, and the way affordable is done currently is really difficult in a lot of markets when you're trying to integrate a drastically different price point and buyer profile into the mix of an existing SFR. But if it's all rent to rent, it might be a little easier to achieve that. So I like that a lot.
I will say this real quick, Chris,
Yeah.
is that, you know, there's a significant premium for an amenitized, maintained BFR community versus the mom and pops out there in that same exact market. I mean, a very significant premium. So in terms of price point, they're like to like going to be, BFRs will be priced higher than your mom and pop. SFR.
That's good.
So not to say it can't help with affordability, but I don't think that's going to be an emphasis, to be honest.
So one of the things let's get a little more technical on this. What are we seeing as the challenges or the opportunities, and how do we finance a project like this? Because it is dramatically different. Dean talked a lot about it, that, you know, it is much more from an apartment standpoint. You know, Mike, Kevin, what are you guys seeing? What are the banks doing? What's kind of the process been?
Mike?
I can jump in real quick. With respect to the lending environment and the lending pool, it's a national program. It's not local. I get calls weekly from all types of different sources of lending that are looking for quality projects. I think the recent shift to syndicate some of the financing has opened up a lot of opportunities for people that are trying to consolidate and generate yield, asset-based yield. So I think it's a very interesting platform with respect to that. There's not a shortage of lenders. And I think a part of it is just to fall back on the economics and the way it works. There is a little bit of educating with some of the local components. I mentioned insurance earlier. That was another one that came up with respect to how a single family home and the entitlements, or if there's CC&Rs involved, on how that works over the long term. I've had a unique opportunity. We're working on 3 communities right now, about 290 units overall. But we kind of walked into one of them by way of an opportunity zone in 1031. So we had some very interesting components that this asset class just started really making a lot of sense for us internally. So it varies.
Okay. Kevin?
Yeah, I'd just say this is just like it's on our radar screen. This is from private money sense, they've really honed in on this too. And I think those that have in the past been strong in multifamily are now looking at this and saying, you know, this is really something we maybe need to look towards as well. And so I think, you know, I'm seeing more almost from the private funding community than, you know, is actually the highest level interest in this. And I do think they're recognizing multifamily builders or developers are recognizing that what they're losing in potential renters there, they need to pick up with this product now, because it's truly what we're seeing, right? I mean, people have decided they for multiple reasons. I mean, post-COVID, you can work at home, but you need more spaces, more flex space, right? You're not just a typical little apartment. You want a yard. You want space for the family because you're all, you know, going to be together more. And I think there's just a lot of things that are on that radar then for what I think is a demand, high demand for over what I want to say the multifamily side. So because we've talked with several multifamily builders that have been strong in that market for years, and they're how do we do this? How do we go about it? let's put a project together.
Yeah, we just had this conversation here yesterday about there's a large swath of people that have built up assets, especially over the last several years in the stock market, and are looking to get out of that and be able to diversify a little bit. And it's created an opportunity to where they're trying to diversify and put that equity somewhere. And as this starts to ramp up, that timing works out really, really well as an opportunity to pull assets out of another class and push that into what we're working on here. So I think that's certainly going to be a trend. And as Dean talked about, this is a mom and pop business. SFR, or BFR is really has historically always been a mom and pop, with 77% of the housing stock owned by one or two homeowners, and so our homeowners are owning one or two units. So that group starts to come in, and if you can start to pull those together, all of a sudden that becomes a pretty big storm of investor pool to be able to capitalize on. Along those lines, somebody asked a question about, do you see production builders retaining a portion of these communities for rentals and keeping them as an ongoing income stream? What do you guys think about that?
We're seeing the builder community. I'm not sure if I'm answering this question right, but we're seeing the builders. You mentioned ago, Christopher, you mentioned a minute ago about what a huge builder here is Lennar is getting into the BFR space big time right now. And other major builders are looking in that space as well. So we're going to see these major production builders do this. And those guys have access to that cheap Wall Street money for their capital. So they'll have that typical advantage they have against in other facets of their business. They'll have here in the BFR space as well, relative to other actors. So, but it reminds me a little bit, this may be getting off topic. Remember the age qualified, the 55 plus, it seemed like every builder wanted to do that, 5, 6, 8 years ago. And a lot of folks got into it. A lot of those folks have kind of fallen away. My guess is we see that with the builder. I'm getting too far ahead here, maybe in the next 5 or 10 years, where we'll see some builders have put their toe in that water, maybe pull their foot out, but others will have gotten in big, and they're going to be permanent BFR developers for the indefinite future.
Yeah.
And again, I don't know if that really answered the question or not.
Kevin and Mike, what are you guys doing?
Well, I think, it's the capital outlay is significant, right? And I think but yet at the same time, I'd say this is what's equalized a little bit. Probably like many of you out there, we've been in the multifamily price point world, and we've looked at the single family versus that, and they've come a lot closer. So, in cost to construct. But still, when you're holding, it's going to be a big public builder probably at this point. Most of the projects we've looked at have been get it built, get it leased up, get the whole thing sold off. And I think that's it'll take the bigger publics if there's going to be a builder holding it. But,
yeah.
And it depends on the size of the project as well, right? And there's some economies to you can't drop it too small. And I think one thing that is interesting too is we have in front of us right now a real problem with costs increasing. And when you have a build for rent, rents increase, but are they helping us as much as a single family for sale, where you can the prices that we're seeing going up, we can help cover some of these increases in costs. Built for rent, it's locked in a little bit. So it's making it tough. And I think that's might lend to a longer play for holding instead. Because I think if you just look at the economics of building and then selling off as a completion of leased up, maybe it's not going to work as long. It's going to be a longer term play.
Yeah, absolutely. Mike?
Yeah, I would just add to this question that, building communities for sale communities and builders retaining rentals within those communities is not a new notion. I've done that. I know people I've been affiliated with have done the same. We've all built communities where by the time we get to the last phase, there's rentals already behind you in the project. So it's not uncommon. to have retention of the BFR from the builder's perspective. We've got a number of different opportunities that have all different origins on why we underwrote it that way, but certainly from our side of it is even if we do retain within an existing community, you know, we're not looking at this in any way as a reduction in value. We're actually viewing it as the same lifestyle and standards that the entire community enjoys. So it's very important to us. It's very important to me personally that we actually feel like we are providing a diversified opportunity. And often the people that are interested in renting the homes could be your next home buyer. You know an awful lot about them. Matter of fact, you probably know more about your tenants situation than you do as your home buyers, because we don't get involved in the mortgage side of it at an intimate level as you do with your tenants. So for us, it's a net add and a net positive aspect.
Yeah, I think we're in the same boat. You know, it is capital intensive to be able to hold off on something like that, especially for those of us that are the smaller builders. But it's definitely on our radar to be able to retain some of those and see if that pencils, and trying to figure out the separation of structure to do that. But yeah, it is capital intensive, and then there is that directs versus rent, and which makes the most sense. You know, it's talking about cost of construction. We've only got a few minutes left here. One of the great questions that was brought up is, you know, dealing with Title 24 and solar. What are you guys seeing the challenges there? You know, is it getting underwritten as an own? Are you doing, you know, obviously the lease is a little bit more difficult when you're in a rent situation. What are you guys doing there?
Well, I can tell you. Go ahead, Mike.
Oh yeah, sorry about that. Yes, we're adding solar, and we're just putting it in and building it into the performance.
Yeah, and I'd say in one that we've looked at, we are SMUD has the program where you can basically, it's not on the units themselves, you're buying credits, and there's a agreement through SMUD for that. So but yeah, you're not going to get around it at this point. They're not letting up on that for BFR.
Yeah, and that certainly works against it just from a cost standpoint. So that's the other challenge, which is always interesting. The one other good question, you know, as we talk about investors and who's holding stuff, what are you guys seeing as the hold time for projects like this?
We have it's really how fast the lead is going to get leased up, right? But looks like if you've got something that you can get through about a 2-year period, depending on the size of the project, right? Really, it's going to come down to how quick does it lease up. I think for most of them that are looking to be moved on as a whole, that's really what's driving that. So if you're saying it from a full sale, Chris, like moving it through it, build it, and take the asset off your sheet. Yeah. Yeah. That's it's. We've got one. It's a 2-year build. About 200 units. That is one that we looked at.
Yeah, for us, you know, it varies by the project. We've got some, as I mentioned earlier, an opportunity zone. So we have a different pro forma. We underwrite it at 10-year hold period just for tax purposes. But with that being said, I'm also underwriting a project that we would retain part and sell part. So it's just kind of depends on the business model underneath it. But I think overall, from at least from our platform, is, you know, we're looking at it as a minimum of a 10-year hold on the underwrite.
Yeah, I think we're seeing similar with that 10-year, you know, primarily, well, for a variety of reasons. But yeah, the tax purposes is one, insurance is another. And as we deal with SB 800, you know, if that's in a hold pattern for that 10-year period, that starts to reduce that risk on the SB 800 take at year 9.5 when the attorneys start to show up and into all of our communities. You know, how are you guys seeing the view of the insurance and, you know, the challenges because it is so new?
You know, for me though, Chris, it wasn't the lack of insurance. It was, to your point about not understanding exactly what structure to overlay on it. And, you know, I've challenged our people, our primary carrier, to give me choices. You know, I want to have options in the marketplace that we don't know down the road, but certainly we have to retain the privilege of having a single family home. And so that's where it gets a little bit confusing. 800 is the obvious thing we have to be mindful of with respect to protecting ourselves and our stakeholders. But with that being said, we're looking at it, and it's being really viewed more specifically, as Dean pointed out, as a multifamily finance and insured asset.
With the weird difference that from apartments, in that if they are truly single family detached homes, if they're down the road, they don't have to be sold en masse. They could be sold onesies, twosies, and that's what does make them a little bit different than any apartment complex.
Yeah, and I'll add, Dean, that sometimes the hybrid of that is you have single family. If there's a common interest community, when you start to sell off and the consumer side of it, it does change that dynamic a little bit, that you can be prepared to have up front built into your program.
Kevin, are you seeing the same stuff?
Yeah, and Mike would be further into this than us. He's been further down this road than us. But I think it's, it is, Dean, you bring up a good point. I mean, it's how you see the product in the end. Are you selling them off individually? Are you, what's going to be the plan? Is it a hold? Is it a lease it up and get it sold and off the books as quick as you can? So we got a couple of programs out there, but we look at it from a builder perspective too, because we've looked at some of these as just a fee builder. What does that do from the builder side? Where does our liability lie? And when it changes hands, does that go with it? Those kind of things. So it is a little bit of a mixed bag. And so kind of trying to put different scenarios and figure that out as we speak.
Yeah, no, I think that's definitely what we're going to experience going forward, and trying to figure out how this asset class plays into our semblance of normal, with everybody involved in the supply chain all the way through the takeout. One interesting question that was just brought up, which I think plays into most of BFR that I've seen so far, has been much more either market rate, but to the higher end, not so much the entry level. And I think, there's certainly an opportunity to bring in some density and get into the affordability side of this. What do you guys think about, and this is, we've got about 3 minutes left to kind of wrap up, but this is, we'll kind of finish with this one. Taking the product and as a for rent, but then looking at it as a model of lease to own. What do you guys think about that?
I don't really in my mind differentiate a luxury lease or a for sale home. It's our company, it's our brand, it's our reputation. And so we're really viewing it as one of the same. We don't feel like there's any distinction. I think that the rent to own has been brought up, in true transparency. It's way ahead of my thought process on understanding how that will work. I probably would say at the moment we're not interested in that, just because of the way the asset is treated as a whole. Something that will come up over time, and especially as you get conditions change where we have a rising interest rate environment, that certainly is an opportunity to get into home ownership.
Yeah, I would add that it has been thought and about, and I think it's a tough one in the sense that you can't, when is the price locked? Are you leaving something on the table? Are you, we don't see it as a viable option at this point. It's just not what really this model is about in our mind. But it is interesting. And I think, again, it depends on the project itself, and how many units are you looking at, and are they? And again, the higher level finish or true standalone, maybe are there multiple, plan types? Does it look like a regular community? And you'd have to probably go to that level to get into a program like that. And then you start asking the questions about the cost you're putting into that product. Does that work? if you know, if you have to fall back to just,
Yeah.
yeah.
All right. Well, as we wrap up here, Dean, Mike, Kevin, thank you for doing this today. I really appreciate it. Special thank you to the Associates Council for putting this together today. And then to our sponsors, Blue Mountain Construction Services, DAHLIN Group, Guild Mortgage Company, the Monty Maxwell team, Integrated Resource Group, Wood Rodgers Inc., and Zurier Company. We can't do this without the help of our Chairman Circle